Welcome to Breaking News to Trading Moves, and welcome to the debate. What if the very thing you've been taught keeps you safe in the market, waiting for confirmation, is actually the exact mechanism guaranteeing your losses?
That is the defining paradox of market timing, isn't it?
Exactly, because, when we evaluate a decision involving financial risk, the natural human instinct is just to wait for clarity. We want to see the breakout, the volume spike, the moving average crossover.
Right. We prefer the data to be visible before we actually commit capital.
Yeah, but we are navigating in an environment where certainty is incredibly expensive. We are looking at a central tension today: the conflict between waiting for market certainty and the actual mathematical cost of entering a trade late.
And that comes straight out of the material we're looking at regarding late market entries.
Right. So the central question we are exploring is whether waiting for confirmation inherently destroys the risk-to-reward profile of a trade by forcing execution at, peak emotional levels. Or does it serve as a necessary safeguard against guessing, provided it's paired with rigorous planning? I take the position that relying heavily on confirmation is often just an emotional crutch, driven by fear. It predictably leads to poor execution and highly unfavorable risk parameters.
And I come at it from a different angle. I see confirmation remaining a vital tool to prevent guesswork. The true failure point isn't the wait for certainty, but rather the lack of a structured plan to manage the execution after that certainty arrives.
Let's examine why confirmation is so damaging to execution. Markets rarely reward certainty. By the time a chart setup becomes obvious, characterized by explosive volume, trailing headlines, and a general consensus among market participants, the cleanest part of the upward or downward movement has already vanished.
Okay, but
You are paying a premium for comfort. Waiting for this level of validation usually results in a late entry.
yeah, a late entry.
And mathematically, a late entry guarantees less upside before you hit profit-taking zones. It also forces a wider stop because the price has distanced itself from the ideal risk point. What traders frequently label as discipline is, it's actually fear wearing a mask.
That's a compelling argument, but consider the alternative. Guessing. Confirmation isn't wrong because it stops a trader from predicting blindly. The problem isn't the act of seeking confirmation. The problem is confusing confirmation with absolute safety. A trader can entirely wait for a setup to validate itself as long as they employ a trading plan that asks a very specific question. Is the risk still acceptable?
But is it ever acceptable at that point?
Yes, if managed right. The damage occurs when action is driven by the fear of missing out once the crowd arrives, not from the simple act of letting the market prove a thesis.
I see why you think that, but let's look at what happens mechanically when a trader waits for that validation. By the time you feel confident, the risk profile has altered completely. Let's call it risk asymmetry decay.
Okay, risk asymmetry decay.
Yeah. Waiting for total confirmation is like trying to buy earthquake insurance during an active earthquake. The premiums, or in our case, the stop distance price, in the exact danger you're trying to avoid. Your mechanical edge is destroyed.
Right, the cost goes up.
Exactly. Late buyers leave themselves no room for standard volatility. Because the entry is higher and the stop is wider, one routine pullback feels disastrous. They're emotionally compromised the moment they execute.
Okay, structurally, you're right about the wider stop. But you're ignoring the exact mechanism designed to counter that, which is position sizing. Your earthquake insurance analogy assumes the trader is buying the exact same coverage they would have bought before the quake began.
Which they usually do.
But a normal pullback only feels disastrous if the late buyer failed to size a position to let the trade breathe. If the execution plan includes a clear invalidation point and the capital allocated reflects the wider stop distance, you can wait for confirmation.
I don't know about that.
You can. You absorb standard volatility without an emotional reaction because the monetary risk remains constant. The math protects the psychology.
But does the math protect the psychology, or does the delay inherently corrupt the math? If you widen your stop, you must reduce your position size to maintain the same dollar risk.
Right, that's basic risk management.
Sure, but by reducing your position size and entering closer to the target, your potential reward shrinks dramatically. Let's talk about the exact cost of this confirmation tax. Let's say your target is $100 and current price is $80. The structural support is $75.
Okay, tracking.
If you anticipate and buy at $80, your risk is $5 and your reward is $20. That's a 4-to-1 ratio. But you wait for confirmation. The price pushes to $90 to break resistance. Now you buy. Your target is still $100. Your support is still $75. Your risk is now $15 and your reward is $10. Your ratio just inverted.
Well,
You are risking $1.50 to make a dollar. The math is completely broken, all because you wanted to feel safe.
okay, you're cherry-picking a scenario where the target remains static. In reality, a true confirmation of a trend often implies the higher time frame target has also expanded.
Not always.
Not always, but often. When resistance at $90 breaks with volume, the new target isn't $100 anymore. It might be $130. The confirmation unlocked a new probability tier.
A new probability tier?
Yes. So buying at 90 with a stop at 80 to target 130 still offers a 1-to-4 risk to reward. The math only breaks if you stubbornly cling to a target that the market structure has already rendered obsolete.
Or if the market just fails to reach that new magical target.
Well, structural degradation only occurs if you take the trade anyway when the reward no longer justifies the risk. You need a strict reason to avoid the trade if the price has moved too far. The confirmation itself didn't ruin the trade. The failure to walk away ruined the trade.
Ah, come on.
It's true. If you wait for confirmation and the risk-to-reward ratio drops below your acceptable threshold, the system worked. It kept you out of a suboptimal execution.
I'm not convinced by that line of reasoning because it assumes the trader operates in a vacuum where emotions don't escalate with obvious price action. When the chart is printing massive green candles and the order book is lighting up, the temptation to abandon the plan peaks.
Sure, FOMO's real.
Exactly. Late buyers enter because they fear missing out. The act of waiting breeds the very anxiety that causes the plan to fail. If you act before the chart becomes obvious, you're making a calm, calculated assessment of risk at a logical support level.
Wait,
You define the risk early, before the emotional temperature of the market rises.
but acting before the chart becomes obvious requires anticipating a move that hasn't materialized. A trade can be right in direction but still poor in execution. If you buy at a support level without confirmation, you might be catching a falling knife.
Not if you know how to read support.
You're assuming the support will hold. Confirmation is the market providing evidence that buyers are actually defending that level. Yes, you pay a slightly higher price for that evidence, but you reduce the probability of an immediate loss. The key is finding the trigger before the move becomes crowded, which is a nuanced middle ground.
You say the math protects the psychology, but you're ignoring who else is doing that exact same math. Let's talk about the structural dangers of these obvious setups, because this middle ground is often a mirage.
A mirage.
Yes. Once the breakout is obvious, you aren't just fighting volatility. You're providing exit liquidity for algorithms, short-term profit takers, and earlier buyers. When everyone sees the exact same pattern, you're buying directly into an environment designed to extract liquidity.
That assumes the professionals are entirely exiting rather than scaling out, and that the remaining move has no value. I would frame it differently. We need to distinguish between a valid setup and an emotional entry.
They often look identical to a retail trader.
But they aren't. The crucial question from the text is, am I entering because the setup is valid or because I am afraid of missing out? The presence of breakout buyers and algorithms doesn't automatically invalidate a trade.
Right, but markets run on liquidity and participation. If you have a predetermined target that makes sense after the entry, algorithmic activity is simply the mechanics of price discovery. They don't automatically guarantee failure.
They don't guarantee failure, but they apply intense pressure because the trade needs to work quickly. When you enter at the most obvious juncture, you're entering precisely where emotions are highest.
The setup might technically be valid on a higher time frame, but let's explain how the microstructure actually works here. Algorithms aren't malicious. They are just programmed to seek liquidity. When late buyers enter after confirmation, they place their stops in obvious structural locations just below the breakout point.
Right. the obvious spots.
This creates a dense pool of resting sell orders. Institutional algorithms drive the price down to trigger those orders. Why? Because that is the only way institutions can fill their massive buy orders without causing slippage.
Okay, yes.
The late buyers stopped out for a loss, providing the exact liquidity the institution needed, and then the trade ultimately goes to the target. You've perfectly executed a mathematically sound plan that delivered your capital straight to the market maker.
Again, that brings us right back to the planning phase. If the stop is hunted, it means the stop was placed in an obvious, vulnerable location, likely too tight because the trader failed to adjust their position size.
So you just widen it forever?
No! A sophisticated trader knows where the retail stops are resting. If you know the algorithms are going to sweep the lows of the breakout candle to generate liquidity, you don't put your stop there. You place your invalidation point below the broader accumulation zone, entirely outside the sweep range.
Which kills the math.
Yes, the dollar risk per share is wider. Yes, the position size must be drastically smaller to accommodate that width. But you survived the liquidity sweep.
But the wider that structural stop needs to be, the worse the math becomes. Instead of entering where risk is clearly defined, the late buyer is forced to enter where the order flow imbalance creates a liquidity vacuum below the breakout.
A liquidity vacuum?
I'll tell you exactly what causes it. When a chart breaks out and prints an expansion candle, all the buying pressure is market orders hitting the ask. They consume all the resting limit sell orders on the way up.
Right.
Once that buying exhaustion hits, look below current price. There are no limit buy orders left because everyone just market bought the breakout. That's the liquidity vacuum. So when the late buyer enters at the top, the slightest selling pressure causes the price to plummet freely until it finds new limit buyers much lower down. The late buyer has to absorb that entire free fall.
But that free fall is precisely why position sizing is non-negotiable. You don't size your position based on the top of the breakout. You size it based on where those limit buyers are actually resting. They don't have a price cushion, but they have a probability cushion.
A probability cushion?
Yeah. They have the mathematical advantage of knowing the trend is confirmed. The core issue is that traders demand safety, which doesn't exist, instead of accepting probability, which does. When you wait for a volume spike in a structural break, you're trading a higher probability setup. The cost of that higher probability is a lower risk to reward ratio. That's a legitimate business decision in trading, provided the reward still mathematically justifies the risk taken. Confirmation is essentially a tax paid to the market makers. You just have to calculate if you can afford that specific tax rate on this specific trade.
I maintain that the only truly clean process is defining risk early and acting before the trade becomes crowded. Execution is everything. You can be entirely correct about an asset's improving momentum. The thesis can be flawless.
Yeah.
But if you wait to act until the headlines hit, your correct idea transforms into a bad trade. The act of waiting for the crowd destroys the edge. A clean process demands acting when the setup is emerging, not when it's universally accepted.
But acting early, before the setup is actually proven, borders on guessing. The core guidance from the material here is to separate the idea from the execution. The idea can be bullish or bearish, but the execution requires answering specific questions.
Like what?
Where is the entry? Where is the trade wrong? How much am I risking? Is there enough reward left? Am I entering because the setup is valid or because I'm afraid of missing out? If a trader answers those questions rigorously, the process remains clean even with confirmation.
Yet how often does a late entry actually satisfy the requirement of having enough reward left? Waiting usually means less upside before resistance or profit-taking zones. It's an inherent contradiction.
I disagree.
You can't demand confirmation, wait for the volume spike, and still consistently find asymmetric reward. By definition, the reward has been consumed by the very price action that provided your confirmation.
It requires patience. It requires the willingness to execute the final step of the plan, having a strict reason to avoid the trade altogether if the price has already moved too far. That's the ultimate safeguard.
Easier said than done.
Confirmation doesn't force you to execute. It gives you the data to decide if execution still makes sense. If the reward is gone, the disciplined trader simply moves on to the next opportunity.
Walking away sounds simple in theory, but consider the emotional reality. A trader says they're waiting for confirmation when they're really waiting to feel comfortable. Once they finally feel comfortable, the psychological momentum pushes them to click the buy button.
Right, they get invested.
They've invested time watching the tape. They've seen their thesis proven correct. The psychological pain of being right but not getting paid is immense. That's why they execute the late entry. The fear of missing out overrides the mathematical reality that the reward is gone.
That's an issue of emotional regulation, not an indictment of confirmation as a technical concept. We need to focus on separating the idea from the execution.
But they are linked.
You can look at a chart, see that your bullish idea was correct, and objectively determine that the execution window has closed. The market doesn't care how long you watch the screen. If you enter because you can't stand the pain of missing out, you've abandoned the plan.
Exactly my point.
But the solution isn't to start guessing earlier to avoid FOMO. The solution is to build a systematic rule that physically prevents you from entering once the price extends past a certain percentage of the target.
You talk about building systematic rules to prevent FOMO. But if the entire industry of confirmation-based trading inherently triggers FOMO, the system is flawed.
Flawed.
Yes, you are placing a human being in front of a flashing screen, showing them exactly what they want to see, and then asking them to do complex math to calculate if the remaining reward justifies the widened stop. By the time they calculate it, the price has moved another 2%. The speed of the market preys on the delay of the calculation.
That's precisely why professional traders don't do complex math on the fly. They use automated sizing calculators. They bracket their orders.
Most people aren't professionals.
You're describing a retail trader scrambling to execute a market order on a mobile phone. We have to elevate the baseline of this discussion. A professional seeking confirmation has already calculated the exact entry point, the widened stop, and the reduced position size before the confirmation ever occurs. When the price hits the trigger, it's a mechanical execution, not an emotional scramble.
Even with automated execution, you are still entering at the top of an expansion phase. Markets move in cycles of expansion and contraction. By waiting for confirmation, the trader is invariably buying at the tail end of an expansion.
Okay, but
Mechanically, the market must contract or consolidate to digest that move. Limit sellers start stepping in, absorbing the market buys. The late buyer is immediately plunged into a consolidation phase, watching their position hover in the red, knowing their stop is miles away. That's a recipe for a panic exit.
I understand the mechanics of expansion and contraction, but a properly sized position neutralizes that panic. If the trader knows the consolidation is a natural digestion of the move, and their stop is placed below the origin of the expansion, they can simply wait.
Wait while bleeding money?
You focus on a target that still makes sense after entry. If the higher timeframe target is substantially higher, a temporary consolidation is irrelevant to the thesis. The problem arises when traders apply day trading expectations to swing trading entries. They buy late and expect immediate gratification.
Which proves my point about the psychological decay caused by waiting. They expect immediate gratification because the tape looked so explosive when they finally gathered the courage to enter. They bought the velocity, and when the velocity vanishes, they realize they're trapped in a poor location.
They trapped themselves.
A trade can be right in direction, but still poor in execution. I would argue that a poor execution inherently corrupts the direction, because the trader will likely be shaken out before the direction resolves. The mechanical disadvantage guarantees an emotional failure.
I'm sorry, but I just don't buy that execution corrupts direction. Direction is an objective reality of price over time. Execution is the personal management of capital. You can have a terrible execution and still reach the target if you simply leave the trade alone.
But nobody does.
The interference is the problem. Traders should focus instead on asking, is there enough reward left? If the answer is yes and the risk is clearly defined, the execution is mathematically sound, regardless of whether the trader feels momentary anxiety during a pullback. We can't blame the concept of confirmation for a trader's inability to manage their own nervous system.
But we must design processes that account for human nature. Waiting can feel disciplined, but sometimes it's just fear wearing the mask of discipline. If a process requires a human being to routinely suppress intense fear and anxiety while watching their capital fluctuate wildly due to a poor entry location, that process is flawed.
Right, but
A cleaner process separates the idea from the execution by acting when the risk is tightest. When risk is tight, fear is low. You know exactly what you stand to lose, and it's a small amount.
Tight risk is an illusion if the probability of being stopped out is exponentially higher. You can have a very tight stop, but if you're guessing at a support level without confirmation, you'll endure a death by 1,000 cuts.
Death by 1,000 cuts?
Yes. You'll take 10 small losses in a row trying to catch the bottom. Confirmation stops you from guessing. Taking a smaller position with a wider stop after confirmation might mean risking the exact same dollar amount, but your probability of the trade surviving the initial volatility is vastly improved.
See, 10 small losses trying to catch a bottom is a myth told by traders who don't understand how to read structural support. If you're stepping in at a high probability demand zone, your invalidation point is incredibly tight.
Assuming it holds?
You might take 3 small losses, sure, but the fourth one yields a 1 to 10 risk to reward because you got in at the absolute origin. The confirmation trader takes 1 winner, but it's a 1-to-1 risk to reward because they entered so late. Mathematically, the early actor is vastly outperforming the confirmation trader, even with a lower win rate.
That assumes retail traders possess the psychological fortitude to take 3 consecutive losses and still execute the 4th trade flawlessly. Human psychology doesn't work like that.
They have to learn.
After 3 losses, the trader is emotionally compromised. They hesitate on the 4th setup, which happens to be the winner because they lack the confirmation to pull the trigger. Confirmation provides the psychological capital necessary to stay in the game.
But that psychological capital evaporates the moment they buy into distribution. When you enter late, you have a higher chance of buying from traders who entered earlier and are now selling into strength. You're absorbing their distribution.
Right, the profit takers.
Exactly. The probability of follow-through drops dramatically precisely at the moment the late buyer enters. The chart looks stronger, but the trade structure is weaker. The internal mechanics of the market have transitioned from accumulation to distribution. You see it on the tape. Heavy volume, but the price stops advancing. Limit sellers are absorbing all those market buys.
That's a sophisticated way of looking at order flow, but it ignores the concept of a multi-leg trend. Yes, short-term traders take profits, but if the core driver of the asset is pushing institutional accumulation, the short-term profit-taking is just a blip.
A very painful blip.
Maybe. The breakout buyers pile in, the algorithms hunt stops, but the overarching trend absorbs that volatility and continues. A structured plan recognizes this. It defines the invalidation point below the institutional accumulation zone, ensuring the late buyer isn't shaken out by retail-level turbulence.
Well, we've spent time dissecting a remarkably persistent challenge in market mechanics here. My stance remains that the market doesn't pay traders for feeling comfortable. Waiting for every signal to become obvious usually means the best risk has vanished. When confirmation is used as a shield against anxiety, it routinely converts a correct directional thesis into a mathematically poor execution. The premium you pay for certainty is simply too high for the math to work long-term.
And my position is that confirmation, when utilized correctly, serves its intended purpose of preventing guesswork. The destruction of a trade's profile doesn't come from the data validating the thesis, but from traders abandoning strict criteria regarding risk amount and remaining reward.
Right.
If a trader relies on a structured plan rather than blind momentum, asking themselves where the trade is wrong and if their reward justifies the exposure, confirmation is an asset, not a liability.
I think we do converge on a crucial reality here. Execution metrics matter far more than the initial directional thesis. Knowing exactly where a trade is wrong and precisely how much capital is exposed dictates survival in these environments.
Absolutely.
We also clearly agree that entering a trade based on the fear of missing out is destructive to any portfolio.
100%. The mechanics of the trade supersede the narrative of the trade. There is much more to explore regarding how market forces actively exploit emotional late entries. It requires continually examining our own execution habits to ensure we're acting on valid setups, not just chasing comfort.
Indeed. We'll leave it to the listener to evaluate their own market timing and execution protocols in light of these mechanics. Ultimately, seeking perfect certainty in trading is like demanding absolute safety in a contact sport. By the time you're fully padded and completely sure you won't get hit, the game has already moved past you.